Is it too late to start investing in my 40s and 50s? Heck no. Now, as you get older, what you need to just focus on is the level of risk you're willing to take. How can I protect my portfolio during market downturns? Now, this is a mindset shift that I want people to think about. And the mindset shift is rephrasing that question. What opportunities do I have when the market turns down? I think that's a better question to ask versus what should I do to protect my assets? Because when the market drops is an opportunity to go shopping. And if you actually don't have more money as well, you can actually restructure your assets to take advantage of the market drop. You actually want more growth than dividends. And the reason for that as well is generally, if your asset grows, you don't pay any taxes until you sell. How you can avoid emotional investing is ensure that, well, whatever you're investing in is not because your next door neighbor is doing it. You need to have your own strategy as to why you're doing it. How much do I really need to retire comfortably in Australia? Welcome to the last episode of Elevate Your Wealth for 2025. So I'm happy to be hosting this. I'm usual host Victor Idoko. I'm financial planner and founder of CEDV Advisory. The last episode and the wrap up is going to be about questions that have been asked throughout the whole year. And it's just going to be addressing those questions. This is general advice only because whatever I say can be used against me, except I say this is general advice. So this is definitely general advice. We're going to talk about investments, property, and everything. So lots of questions to go through. And, over the last year, so many things have happened. There's been lots of talk about the markets, when the Trump tariffs and everything going on, the markets dropped a lot. We also had rate drops, which have been great for lots of people. Property prices as well have been going up. Inflation was a big talk beginning of the year. Now we hear barely anything about that. So it's been a big year so far. Okay. And now, one thing we have seen with lots of people came and they were asking me a lot about SMSFs and inheritances, which was kind of a unique year for me in that regard. So we'll touch a little bit about that as well. The first part we'll talk about will be the questions we've received around investments. Okay. And the first one here is, how do I know I should invest in shares, property, or both? Okay. This is a very important one because look, there's no real right figure as to or percentage where you should put in property versus what you should put in shares. However, as you get older and as you get closer to retirement, you want a lot of diversification, and you also want a lot of liquidity. So what that means is you need to hold less property as soon as you get closer to retirement. Before you get to that age, very tricky one because yes, you want lots of diversification, and then property takes a huge chunk and is concentrated a lot. So I would really say it depends on your situation. However, an easy way to think about this is whatever you can do first and you can do next, keep doing that. But over the long term, you want to diversify, but that's a question we get. When I sit down with each individual client, we can actually say, okay, what's the next step and what should you be investing in? Another question we get is, what's the difference between ETFs and managed funds? Okay, so that's a good one as well. ETFs, as the name implies, is electronic traded funds, and managed funds are pooled funds together that are managed by a fund manager. An ETF is also managed by a fund manager generally, okay? But with an ETF, the key thing is you can trade anytime of the trading hours within the day. So you can buy and sell straight away. While as with managed funds, you cannot do that. You can only trade end of the day. So those are that's the main difference between both of them. I would also say people always want to buy ETFs. Sometimes you don't get a big range of ETFs like you do in managed funds, but generally you can get as much. How do I know if my super is invested the right way for my age? This is where you need to sit down and do a risk profile and also ensure that, okay, you have a certain time frame as to when you want to retire. Generally, what I tell people is, if you want to retire in less than 10 years, you really want to ensure your risk profile is right for that time frame. Generally, more than 10 years, you can afford to take some risk. Okay. And what that means is taking some risk to help build and grow the fund until you're closer to retirement. Because what that means is you end up having more money if you take more risk. And with a 10-year time frame, generally, if there's 1 or 2 downturns, you have enough time to recover from that. Should I consolidate multiple super funds? Okay, another interesting one. General answer is yes, you should. Sometimes if you have multiple insurances in different super funds and you're not able to get a comprehensive cover, that is your fallback plan. So yes, you then end up having multiple superannuation accounts. So you do not want to consolidate in that regard, because you will lose those superannuation accounts. You would lose those insurance products in your super, which is not good if anything unfortunate was to happen to you. How much do I really need to retire comfortably in Australia? This is very dependent, okay? So there's some stats out there that show, okay, if you're a couple, you need about $67,000 per annum to retire comfortably. And, the amount you should have in your super then should be about $680,000 as of today, okay? Now, you move that a year from now, it changes. You move that 10 years from now, it changes. You add in someone that wants to travel premium economy versus just travel economy. You add someone that wants to travel twice a year internationally, that figure changes. So it's very dependent and subjective to what you want as an individual. But it's definitely something we work out with clients as to, okay, well, what you need, what can we do? I was speaking to a client the other day and he was like, well, okay, for the first 5 years of retirement, he wants to travel a lot with his partner and they want to see the world. So they need double the amounts that they would need after that. So really depends on a lot. So it's a million dollar question and it's very subjective. What's the difference between accumulation and pension phases? That's a very good one as well. Accumulation, just as the name implies, is you're still accumulating funds. So you're still contributing to your super and making that grow. Once you move your funds to the pension phase is when you're actually taking out funds from that super and you're taking it out consistently. You can almost think of the pension phase as when you have stopped working, but you're now taking a salary from a super and you're taking that consistently to live. So first question is, what's the smartest way to structure my home and investment loans? Okay, home loans, generally, it is using some debt recycling to pay that off quicker and then reduce your taxes, generally. Investment loans, another tricky one. I have the opinion that interest only is one of the good ways to do it, as long as you're using the principal for something else. And what that looks like is, let's assume repayments of 5,000 P&I, but if you then go interest only, you're only paying 4,200. Now that $800 every month should be put into another asset that grows for you, and then you will be moving ahead. Okay, and that asset should be more than the interest, should give you a return more than the interest which you're paying long term. Okay, so that's one of the ways to structure your loans. How does an offset account differ from a redraw facility? The net benefit is the same, but how one works, which is the offset, it just reduces the interest. Okay, but if you put it into the redraw, your total repayments reduce. Okay, so that's just the difference there. With the redraw facilities, sometimes the bank, in very few circumstances, will not allow you take out the amount from redraw. So if you want full access, it's better off putting that into an offset. How can I use my equity to invest, and should I? So generally, using your equity to invest just means you've factored in a few things. One, your cash flow is good. Next section is property. Okay, so how do I decide between buying a home and an investment property first? Okay, my opinion on this, and what's really important as well, is people should take as much advantage of buying a home because you get lots of concessions. So with those concessions, then you can use that or even convert that to investment property down the track. I know sometimes location doesn't help with that, so you just need to look at your situation. But I always encourage people to, if they've never bought a home before, look at buying a home first and then actually use that as an investment property down the track. A few rules are around those as well. What should I look for in a high growth suburb? Okay, this is a good one. I always default to my buyer's agent to be like, hey, buyer's agent, do the research. Because look, they have the tools. However, the two things that I personally look for. So one is very low vacancy rates. What that means is there are very few properties that are empty. Okay, so very important because what that also entails is that suburb is a high demand suburb. So that's one. The other one as well is the rental yield. The rental yield is a indicator of future growth because it just means that people are getting lots of rental income from that, or that suburb is demanding lots of rental income. So the growth in there should be more than average over the long term. There are few quirks or a few things to look at as well, because sometimes some low socio-economic areas actually have a high rental yield and they don't have as much growth. So a few things there to look at. But those are two things I look for high growth about. How much do I need in Super to make an SMSF worthwhile? So as I said, look, if you have $500,000, makes sense. Some people have done it for $200,000 because they were able to make contributions, or the asset they were trying to buy, we still had enough for liquidity, or there was money coming in short term. So it's a very hard question to answer. However, $500,000, I don't see there being any issue, except you want to buy a $2 million house. Okay, then it becomes, well, that's a huge amount. That's a huge asset to buy with $500,000. What can I invest in through my SMSF? Generally, you can invest in as many and diverse things as you want, and that's one of the reasons people set up an SMSF. So a few things that might be classic cars, might be art, might be commercial premises. So anything, your rules around whatever you invest and how you can store them and how you can use them. And the main rule there is it should not provide benefit to you now, but other than that, you can pretty much invest in anything. It just has to make sense. And when I say make sense financially. Okay, what are the risks and responsibilities of being a trustee? This is an important one because the trustee, you are ultimately responsible for the SMSF. You use professionals to help you, but you still are responsible. Doesn't mean the professionals can be negligible. It doesn't mean they can give you bad advice, but you are ultimately responsible for the SMSF. So the risk and key responsibilities there is, if anything happens to the SMSF, you can be faced with penalties, okay? And generally, the trustees are the members as well. So it just means you lose your SMSF money because you can be charged at the highest marginal tax rate. What's the real difference between life, TPD, trauma, and income protection? So I'm going to be cheeky here and say we've done a podcast on this, so go check out the podcast. But all those cover different events, so different life events. So one is if you pass away, what your beneficiaries get. The other one is, well, if you suffer an event, what do you get? And income protection is an income stream. How much cover do I actually need for my family? Really depends. We need to go through an insurance needs analysis to see, okay, well, what do you want for your family? Most people just factor in clearing off the mortgage, but that is, not even scratching the surface as to what you would actually need. All these are considerations. So generally, you have your key person and business insurance alongside your personal insurance. Okay, wealth building and family finance. Okay, so I always like to think about this as family wealth. Okay, so these are key questions that we get as well. So how do couples successfully manage money together? I like this one because basically how they do that is just intent and being clear as to what they want and what they want to achieve with your wealth. Okay, because if one person wants to achieve something else and the other person wants to achieve something else, it's going to be very hard to be successful in managing your money as a couple. And I think the other thing as well is just getting an objective person in that situation and generate financial plan. Sit down, understand the goals, and come up with a plan. Okay, so that way, both people are feel heard and are in a situation where you're comfortable with the outcome. What's the best way to teach kids about money early? Okay, so best way is making it as simple as you can, but do not teach them. Or rather, I think a better way to put that is ensure you're still teaching them even if you can't simplify it. And the reason for that is they would listen, and even though they don't understand it at that point in time, later on they will fully get that concept. But there are lots of educational material out there as to how to teach kids to teach kids to invest and manage money. I always tell people as well, I got my money attitudes from my parents, so they did a very good job in that regard. And, I think they really started teaching me about money from a very young age. So I encourage people to do that and use the tools. So we have some tools, or we have some books that we actually give to parents to read to kids, and, ensure that they're teaching the kids as much about money as they can. Thanks for tuning into Elevate Your Wealth. So this is just a wrap up session of questions for the last year. So I am Victor Idoko, financial planner and founder at CFA Advisory. And, I'm a CFA charter holder. I am a certified financial planner, and I hold a master's in finance. So I do know my stuff. And if you're wondering that, okay, well, how do I get clarity on this? What next steps do I take? I need some advice. You can reach out to us. You can go to our website. It's cfadvisory.com.au or cfvservices.com.au. Each of those links will route you to our website, and we can help you. We can help you answer the questions, get to the vision you want, and help your next year be a wonderful year. So we've done lots of videos, and we have lots of material out there. So feel free to reach out. I've also written a book, and a few more are coming as well. So that can be good stepping stones during the holidays to learn more about financial planning. But reach out if you need help. Until next time, enjoy your festive season.